Yes, welcome to our class today. My name is Mr. Darwin. Today we are going to look at financial accounting, and we will start with our first revision paper, which is the most current paper, which was done on 22nd April 2025. This was done together, the students of CPA foundation level and the one for CIFA foundation level. So we will go question by question as we try to see the questions and come up with the appropriate answers for those questions. The paper had 5 questions. We will record each question one by one and try to get the right appropriate feedback. Now the first question, that was question 1. I think question 1A. The question was asking, in the context of public sector accounting, outline 4 principles of accrual accounting. I'll take it again. In the context of public sector accounting, specifically, that is public sector accounting, outline 4 principles of accrual accounting. So, when we talk about accrual accounting, basically this is a method of accounting that records financial transactions when they are earned or incurred. This means that when the period at which those financial transactions were earned or incurred, that is the date, or within that is the period when we are going to record them down. So regardless of when cash is received, sometimes cash can be received either later, it can be 2 months later, 3 months later, or it can be paid later, but you find that an expense has been incurred within a specific month. So in relation to the public sector accounting, this method aims to provide a more accurate picture of financial performance and position than having a cash-based accounting in the organization. So basically we have been asked to give 4 principles of accrual accounting, because I have already said that accrual accounting is a method which is used to account for records of financial transactions when they are earned or incurred. So the first principle is recognition of revenue and expenses. When you talk about this principle, we are talking about recognition of revenue and expenses. This principle of recognition, revenues, and expenses is a very fundamental principle to accruing or accrual accounting. Under this approach, revenue is recognized when it is earned, meaning that when the service is rendered or the goods are delivered, regardless of when the actual cash is going to be received, or likewise, expenses are recognized when they are incurred, which is the point at which the obligation to pay arises, not necessarily when payment is made. So this method ensures that all income and expenses are attributed to the period in which they relate, providing a more accurate representation of financial performance and resource usage. So in the public sector, this will help stakeholders to understand not just the cash flow, but the real economic activities and obligations of the entity within a period. Let's take, for example, we have an example that, let's take it an example for a government hospital. There's a scenario whereby a government hospital treats 500 patients in June 2024. under a national health insurance scheme. Now, the insurance reimbursement rate is 5,000 per, let's take it as 5,000 per patient. Now, the hospital receives payment is done in July 2024. So how are we going to treat this? Here, in terms of accrual accounting treatment, as per this part, we are seeing that revenue is recognized in June 2024. That is when the patients were treated, and that is when that money is earned. But payment of that money is done in July 2024, within that period. So the journal entry here is that we are going to debit account received in June 2024. In June 2024, the revenue that was recognized, the accrual, here we are going to, let's talk about this is account received or receivable. We have the debit and we have the credit side. So account receivable, we are going to debit 2,500,000. How do we get 2,500,000? We are being told that 500 patients were treated in June, and payment per patient was 5,000. So basically that is 500 times 5,000. Sorry, we are going to get that will be 2.5 million. So that is the revenue that was earned in June 2024, but payment was done in July 2024. So in terms of the journal entry in June 2024, we will debit account receivable, and of course we are going to credit, we have a service revenue. We will credit let me take this. We will credit 2,500,000. So in this is going to be in a journal of revenue revenue recognition. So this is in terms of revenue recognition. And then in the cash, in the journal entry on June 2024, of course we have read that, in the cash received in June 2020, in July, sorry, in the cash that was received, because we are being told that payment was done in July 2024. Here in our journal entry, we are going to debit cash, which is 2,500,000, And then, of course, account receivable, we credit it at 2,500,000. So you see, what this statement, the impact of this financial statement is that it shows that the revenue of 2,500,000 was incurred in June 2024, although it was received in July 2025. So specifically, this tells you, as we have said on the principle above here, the principle of recognition of revenue and expenses. The principle of recognition and revenue expenses states that revenue is recognized when it is earned. So the revenue of 2,500,000 was recognized in the month of June, although payment was done in the month of July. So in terms of the records, we will have to record that as in those journals, whereby the account receivable, we debit the 2,500,000. Then in terms of the service revenue, we credit 2,500,000. In terms of July, when the cash was received, we debit cash, and then account receivable, we credit the same amount of 2,500,000. The second principle of accrual principle to public accounting is that the matching principle. The matching principle states that in accrual accounting, it ensures that all expenses are recorded in the same period as the revenue they help to generate. That means that this principle is very crucial because it provides a more accurate measurement of financial performance during a specific time frame. By aligning revenue with their associated costs, the entity avoids inflating or deflating profits figures in any given period. So in the public sector, this is especially important for programs or services that span multiple months, as it ensures that all related costs and income are reported together, reflecting the true cost benefit of the public initiatives. So like for example, let's take an example here. Assuming that a government school organizes a vocational training program in August and charges participants a fee generating income for the purpose of running the program. So the school incurs costs such as printing training manuals and paying instructors, and even if payment for manuals is made in September, both the revenue and expenses must be recorded in August. We are assuming that now the training is taking place in August and the payment will come later. So this so in terms of recording payments in September, though the revenue and expenses in terms of recording the payments and expenses in August, although payment is going to be done in September, this will ensure that the financial reports for August are accurately showing the full picture of the program's performance, enabling better evaluation and decision making. So take it for example, in that program that was done, let's say in August 2024, the fees collected from the participants, let's have that, fees collected equals to 1,200,000, which is earned, this is earned in August. Now, if you look at the revenues incurred, first there's the printing of manuals, which cost 300,000. and then these were ordered in August, but payment was done in the month of September. And then instructor fees, this is number 2. Instructor fees was 500,000, whereby the instructor worked on August, and probably they were paid in the same month. So how do we handle this? Now, in terms of recognizing this, the first step is that we start by recognizing the revenue. So the revenue here is that we collected our revenue from the fee collection, which was 1.2 million. So in our journal entry, we are going to enter as accounts receivable. We will have the debit and the credit side. So in terms of account receivable, we are going to credit the revenue of 1.2 million. And of course, in terms of the program revenue, we will credit also 1.2 million. Then the next step will be we are going to recognize the expenses. In the recognition of the expenses, the first expense we said is about printing of manuals. Which cost us 300,000. And of course, in terms of recording this expense in a journal, we are going to record printing expense. We will debit and then credit. We are going to debit 300,000. And of course, in accounts payable, we will credit 300,000. And then of course we have the second expense. Let me take this. Of course, we have the second expense was the instructor's fees, which was 500,000. So in this expense, because it was paid in the same month in August, so there's no accrual needed because the expense was paid within the same period. So in our journal entry, we will debit, sorry for that, we will debit instructor expense of 500,000. And then on the credit side, we are going to credit cash at 500,000. So on this expense, as I have clearly indicated, there will be no need of accrual needed because the expenses was incurred in August. At the same time, that expense was paid in August. So there is no accrual in that expense. So payment of accrual expense in September 2024 will then be only the expense of printing that we said, which was earned in August, but payment was done in September. So in terms of accrual for that payment expense, the payment, so the third thing that we look at is payment for accrued expenses, that we are going to have accounts payable, whereby we'll debit 300,000, and then cash, we are going to also credit 300,000, because that is the only expense. If they were both, then we could have added the other expenses. So you see, in this principle of we are talking about the principle of matching principle. Here is that we are matching income and expenses. So in terms of the financial impact in August is that in the program revenue, we are going to realize that the program earned a revenue of 1,200,000, and then there were expenses. There were only two expenses. The expenses were the printing manuals at a cost of 300,000, and then the instructor fees of 500,000. So the net profit will be 1.2 million minus 800,000, all the expenses accumulated, which will give us 400,000. So the 400,000 becomes the net profit earned from that program. Remember, do not forget about our question. Still, we are answering a question that in the context of public sector accounting, outline 4 principles of accrual accounting. So then we have the third part, which is full disclosure. The principle of full disclosure. The principle states that the full disclosure principle requires that an organization's financial statements, including all material financial information necessary to understand its financial condition. In the public sector, the principle plays a crucial role in maintaining transparency and accountability. It ensures that all relevant information, such as outstanding debts, future payment obligations, and the ownership of assets, is presented, even if related cash has not yet changed hands. So this way, stakeholders, including the taxpayers, oversight agencies, and donors, can make informed assessment of the entity's financial standing. So when we talk about full disclosure, think of it, let's take an example of a public agency borrows funds from a development bank and uses the loan to purchase industrial machinery. The financial statement should clearly reflect the loan as a liability, even if repayments have not started. Then the machinery as an asset, showing its contribution to operational capacity. Then an interest due but not paid as an accrued expense. So this details disclosures ensures that users of financial statements can use or can see the agent's true financial obligations and assets, not just those that have been settled in cash. So in this aspect, assuming you have a loan of 50 million, which is received in January 1st, let's have 1st January 2025, and the loan terms, the terms are, for example, interest is charged at 8% per annum. Then this is per annum. Then repayment starts after 1 year. So repayment will start in 1st January 2026. The loan tenor is the loan period is 5 years. So if you have this information, you will start by recording loans and asset purchased. So the initial loan received, which was on 1st January 2025, was 50 million cash, and records a long-term, which is a long-term liability. So in terms of, let's say for example, if we were to start recording in our journal entry, we were to have cash of the loan, so we could debit cash of 50 million, and then on the credit side we are going to have long-term loan payable, long-term loan payable, we credit 50 million. Then the purchase of machinery, on the same, we can debit industrial machinery, which is an asset. We debit the 50 million, then of course we credit cash. On the accruing interest expense, as at that 1st December, of course, because now this machinery is purchased at in the 1st of January 2025, so which means that there is accruing amount of interest because payment is going to start in 1st January 2026, and we have been given the interest is 8% per annum. So by 2020, as at that 1st December 2025, the accrued amount of interest is 8% of 50 million, which comes to 4 million. So in terms of records, in terms of the journal entry, we will debit the interest expense. At the same time, we credit the accrued interest payable. In terms of depreciation, we have not been given the depreciation rate, but assuming that the depreciation rate is at let's say 10%, maybe the machine depreciates from 2025, maybe is good for 10 years with no salvage value, then the annual depreciation, assuming that the depreciation, it can be sometimes when needs to be, you can be given the depreciation rate, maybe 8 or 10%, 20% or stuff like that. So if you're using 10% depreciation, so depreciation of 10% of 50 million is going to be 5 million. And depreciation can either be done in a straight line or it can be done on a reducing balance. So you can be given that information. So depreciation for the first year, if you take 10% per annum, so 50 million, 10%, that will be 5 million. So in terms of records, in preparing a journal entry, you can debit the depreciation expense and then credit the accumulated depreciation of the machinery, which is 5 million. Then our next principle, which is the 4th principle, will be the depreciation of assets. So we always have this depreciation. Depreciation is a method used to accrue accounting, in accrual accounting, to allocate the cost of a long-term asset over its useful life. This means that instead of recording the full expense, the full expense of capital asset, in the year it is purchased. The cost is gradually expensed over the years the asset is used. This approach aligns with the matching principle and ensures that the expense reflects the asset usage over time. In public sector accounting, this is essential for proper asset management and budgeting, especially for infrastructure and equipment that last many years. So, like for example, think of this scenario whereby the government purchases official vehicles, and assuming in 1st January 2025, the government purchased vehicles worthy 10 million, let's say. The estimated useful life for these vehicles maybe is 5 years. Residual value is 0. We are assuming that there's no salvage value. And the depreciation method is a straight line, which means that we are going just to have the depreciation amount based on the value of the vehicle all through. So we need to calculate an annual depreciation. The annual depreciation equals the cost minus the residual value useful life. So that will be 1 million. Then residual value is 0. Sorry, we will divide it. The residual value, the correction part is that the annual depreciation is going to be the cost divided by the residual value useful life, which is going to be 1 million, because I've said we have 1 million. Then we divide it by 5 years. That is going to be 20,000 depreciation. Oh, sorry. That we said at first. I mentioned it was not 1 million per 10 million. Sorry for that. It's 10 million. So that is going to be, depreciation is going to be 2 million per year. Of course, I gave more principles. I can just mention them. There's the principle of liability recording. So under accrual accounting, liabilities are recorded when an obligation arises, not when payment is actually made. This ensures that financial statements present all financial responsibilities of the entity as of the reporting date. The principle is particularly relevant in the public sector, where government often commit to services, infrastructure, or salaries that are not immediately paid. So by recognizing such obligation promptly, the accounting records provides more honest and realistic pictures of the government's financial position. Of course, we have the principle of enhanced transparency and accountability, which states that the accrual accounting provides a comprehensive view of an entity's financial health by showing what it owns as asset and what it owes as liabilities, and its net financial position at any given time. So this transparency is very critical in any public sector, where accountability to the public donors and even oversight bodies is very essential. So by recognizing all economic events, whether cash has changed hands or not, accrual accounting fosters trust and support better planning, governance, and financial management. Of course, we have the principle of consistency and comparability. The principle of consistency ensures that accounting policies and procedures are applied uniformly over time, while comparability allows for financial information to be evaluated across different periods and organizations. Accruing accounting with its standardized practices makes this possible by ensuring that similar transactions are treated the same way. And of course, we have the principle of compliance with the International Public Sector Accounting Standards, which provides a global framework for accrual-based public sector accounting, which is designed to ensure that there is quality, comparability, and transparency of financial statements. So governments adopting the IPSAS align themselves with the international best practices, which improves credibility with lenders and development partners and even citizens. Now, question 2. In this part, question B. We are still under question 1. Part B. The question asks, explain how the following items are disclosed in the financial statements of a club. We have the life membership fees, and of course, we were given the specific donations. Now, clubs and other non-profit organizations prepare financial statements such as the receipts and the payments account, the income and expenditure account, the financial statement of financial position, which is the balance sheet, and the treatment of certain items like life membership fees and specific donations are very important for accurate reporting. So, we have been asked to explain how the following items are disclosed in the financial statements of a club. So, when you talk about life membership fees, life membership fees are one-time payments made by members to obtain lifetime access to a club or association, unlike annual subscription fees that are recurring in nature. Because these fees are not earned regularly and cover a period extending beyond the current financial year, they are not considered operational income for the year in which they are received. Instead, these payments are classified as capital receipts, meaning that they contribute to the long-term financial strength of the club rather than its annual income. So the main part here is that these payments are classified as capital receipts. So in terms of accounting treatment and disclosure in financial statements, first, we are going to have them. We are going to have a receipt and payment account, whereby live membership fees are shown on the receipt side as capital receipt. They are recorded separately from regular revenue like annual subscription to highlight their non-recurring nature. Then number 2, the income in the income and the expenditure account. Since these fees are not earned on a regular basis and are not directly related to the current year's operations, they are not shown in the income in this account. So this avoids overstating the surplus or performance of the current year. And in the balance sheet, the live membership fees are shown under the capital fund or general fund on the liability side of the balance sheet, because they are post-paid. So in some clubs, if there's a policy to gradually match this income over time, like for example, you can have an over the average life of the membership, a portion may be transferred each year from the capital fund to the income and expenditure account. This reflects a systematic recognition of the revenue over the benefit period. And when it comes to specific donations are funds received by a club or non-profit organizations for a particular purpose, such as a construction of a new building. It can be purchasing sports equipment. It can be setting up a scholarship or any other clearly defined use. These donations are not treated as general income because they are restricted in nature and cannot be used for general operating expense income, explicitly stated. Instead, they are considered capital receipt meant to support long-term development or a specific project. Accounting and proper accounting and tracking are essential to ensure that these funds are used exclusively for their intended purpose. So in terms of accounting treatment and disclosure in the financial statements, first, in the receipt and payment account, the donation is recorded as receipt and a capital receipt. It's important to distinguish it from ordinary donations or subscriptions income to highlight the special purpose in nature. When it comes to the income and expenditure account, since it's not meant for general operations, the amount is also not included as income unless the donation specifically funds operation activities, e.g., we can have a donation to cover salaries or day-to-day expenses. So this avoids distorting the club's regular income and expenditure results. Also, in the balance sheet, until the donation is used, it is shown as a liability or as part of a specific reserve fund. So once the money is spent on its intended purpose, the liability is reduced accordingly. So any unspent portion remains as unutilized specific donation under liabilities, ensuring transparency about the fund's usage status. Now that is how you treat both the specific donations and the life membership for the club, or even for in a non-profit making organization. Question number 1C now, part C. Now this is a bit mathematical. We are going to do some calculations here. The question states, Kilimo Enterprises commenced its operations on 1st January 2021. The firm acquired several items of plant for its use. So we have plant movement extracts for the years ended that 1st December were as follows. We have the plant at cost in the year 2021, 2022, 2023, 2024. So in plant at cost in 2021, we are given 80,000. That is 80 million. It's in terms of thousands. So we have 80 million. 2022, we have 80 million also. 2023, we have 90 million. And we are not given in 2024. Accumulated depreciation. In 2021, we are given 16,000. In 2022, 28,800. In 2023, we are given 36,700. So we have to find it for 2024. And our net book value, it's in 2021 is 64 million. 2022 is 51,200,000. 2023 is 53,300,000. Then we have additional information. First, we are told disposals took place as follows. Plant W, which was acquired at the commencement of the business at a cost of 15 million, was disposed of at 8 million on that 1st December 2023. Then, on that 1st December 2024, Plant X, which was acquired on 1st January 2021 for 30 million, was disposed of at 21 million. And in terms of acquisition of our plants, Plant W was sold and replaced on the same date with Plant Y. The value of Plant Y is to be determined. So we are going to find that. Then Plant X was sold and replaced on the same date with Plant Z. So Plant Z was acquired at 50 million. And number 3, depreciation is provided at the rate of 20% per annum on reducing balance. So not on reducing balance, because I said depreciation can be calculated on a straight line or it can be calculated on reducing balance. So on this we have been specifically been told that the depreciation is on a reducing balance. Then required extract of a plant movement schedule for the years ended 2021, 22, 23, and 2024. Now, of course, we have prepared that, but we will go one by one to understand how we came all about this. Now, in terms of preparing a PPE, you need to understand that a movement schedule in accounting is a detailed statement that tracks the changes in the value of assets, and especially the non-current assets, or what we call the fixed assets, over a specific period. Think of it as a timeline that shows how assets have moved in and out, or in and out of the books, and how their values have been changed due to things like purchases, disposals, and depreciations and all that. So when we are preparing a PPE includes the assets at cost, which is the opening balance at each asset. Then we have the additions, which is the new purchases that happen within a specific period. Then we have depreciations, which we refer to as disposals, which are the sales or the, sorry, not depreciation, I will talk about depreciation. We have the disposals, which are the sales or the write-offs. So as I started, I said that we have the opening balance of each assets. Then we have additionals, these are purchases within a specific period. Then we have disposals, which are the sales. Some assets will be sold or will be written off. And then of course we have depreciations within specific period, of which here we have been told that the depreciation happened at the rate of 20% per annum on a reducing balance. And then of course we are going to have the closing balance, which is the book value, which is the net book value of each or of specific asset at the end of each year. So from the question, we have been clearly been given the rate whereby the plant at cost in 2021 was 80 million, of which was carried forward to 80 million in the second year. Then 2023 we have 90 million and stuff like that. So in preparing our PPE, so we have understood the question. So to start off, we have so we have 20, our information is 2021 to 2024. So we have 2021, 2022, 2023, and 2024. Now, when preparing a PPE, you need to know that anytime you purchase an asset, you need to recognize it on the book at its cost. So remember that anytime that you purchase an asset, you need to recognize it at the book at its cost. So at this first part, we are going to have the assets at cost. So we have been given them in terms of thousands. We don't want to use the big figure in terms of millions. Now, the assets at cost, so as shown here above here, we are going to start with the balance brought forward. We have been given that information in our question. Plant at cost in 2021, the balance carried forward is 80,000. So here we will start with 80,000. So we have been given that. And in that now, period for 2021, we look at the additions, because we said we are going to look at the additions, and then we will talk about disposals, and then we'll have the totals. Then after doing this, later we shall then come to the depreciation. Let's go with this first. So in as per the question, we have been given the plant at cost is at 80,000. Do we have any additions? Do we have any additions from information? As in 2021, the plant W was which was acquired in commencement of the business at plant W, which was acquired at the commencement of the business at cost 15 million, was disposed at either on that 1st December 2023. On 31st December 2024, plant X, which was acquired in 2021 at 30 million, was disposed in 2021. In terms of additions, plant W was sold and replaced on the same date. And here above, in additional information number 1, we have been told that plant W, which was acquired on the commencement of business at cost of 15 million, was disposed at 8 million on that 1st December 2023. So plant Y, which means was acquired in 2023. So plant X was sold and replaced on the same date with plant Z. And here we have been told that on that 1st December 2024, plant X, which was acquired on 1st July 2021, 1st January 2021, was disposed. So plant Z, which means that was purchased in 2024, depreciation and all that. So this means that in terms of additions, we do not have additions in 2021. When we go up in terms of disposal, is there any plant which was disposed in 2021? No, because the plants that we have, it's plant W, which were disposed, and we have been told that plant W was disposed in that 1st 2023, and on that 1st December 2024, plant X was acquired on January, which was acquired on 2021, was disposed. So the disposals are happening on 2023 and 2021. So in 2021, we will find that we do not have any disposal. So so that means that our balance carried down here is going to be 80,000, because we are talking about the information as asset at cost. Then come to 2022, the balance carried down in 2021 will be the balance carried forward in 2022. So in 2022 we are going to have 80,000, okay, which is 80 million, because we are putting in terms of thousands. Equally, if you look from the additional information, we have said there is no plant that was either disposed or acquired in 2022. So equally in 2022, we will not have any additions at the same time. So our balance carried down is going to be 80,000. So in 2023, our balance brought forward will be 80 million. It's in terms of thousands, so it's going to be 80 million. Now in 2023, we have additional information. The additional information 2023, we are told here that disposals took place as follows. Plant W, which was acquired at the commencement of the business at the cost of 15 million, was disposed of at 8 million at that 1st December 2023. So that tells you that in terms of our disposal, we have a plant that was disposed in 2023. Now, when we record assets in a PPE, we are not interested at their sales proceeds. Here, we are interested at the cost, the asset at cost. So, plant W in 2023 that was disposed in 2023 was costing 15 million, which was acquired in 2021. So in terms of the disposal, here we are going to put 15 million. So we'll put in little brackets because we are going to, because it was disposed, we are going to reduce it. Then in terms of additions, we are being told here that if you read number 2, additional information number 2, plant W was sold and replaced on the same date with plant Y. The value of plant Y is to be determined. So, then how do we find the value of plant Y? We can find the value of plant Y by preparing a T account. Let's do a T account for plant W. In the T account, we credit the disposal at cost, and then we debit the opening balance, and then credit the closing balance credited. So at this point, the balance brought forward will be 8 million. Then the balance carried forward. Now, in terms of the balance carried forward, if you look at our question, we have been given the balance carried forward to 2023 is 90,000. So, in preparing our T account for that year, the balance carried forward is 90,000. Then we are going to credit disposals, where we have been told, if you look at the disposals, we have been told that if you look at this question, we have been told that plant W, which was acquired at a commencement of the business at as cost of 15 million, was disposed at 8 million. So the disposal here is 15 million. So the balancing figure is going to give us the amount in bank, which will be the cost of plant Y. We need to determine the cost of plant Y. So this is going to be 105. And then, of course, the balancing figure is 105. Sorry, the balancing, I should have indicated here 80,000. Or 80 million for that matter, because I'm using millions, so I have that 80 million. Because for the plant Y, we are talking about the balance carried forward. I mean balance brought forward. So the balance brought forward in 2023, according to the question we are given here, in 2023, the balance that is from the previous year for 2022, the balance brought forward is 80,000, and of course the balance that is carried down will be 90,000. So we have said we debit the balance brought forward, which is 80 million, then we credit the balance carried forward, which is 90 million. Then the disposals were 15 million. So if you less 105 minus 80, that will give us 25 million. So in terms of determination, so 25 million, this figure that we are looking for, this becomes the cost of plant Y, because we are told that plant Y is to be determined. So for us to determine that plant Y, we know that additions were done. So these are the purchases. So from this aspect, if we are able to add now 80 plus 25 gives us 105 minus 15, then that gives us 90,000. Because the 90,000 that we have been given the question, we have been shown that that is the amount that was carried forward. So it means that in the year 2024, the balance brought forward from 2023 will be 90,000. So in terms of also in additional information, let's see if we have the additions and the disposals. I think in this is a bit clear. We are being told that in 2024, on that 1st December 2024, plant X, which was acquired on 1st January 2021 for 30 million, was disposed of at 21,000. So I have clearly said that in the PPE, we are not interested on the sales proceed, but rather we are interested, or we are only recording the purchase at cost. So this plant X was disposed in 2024. So in 2024, our disposal will be at cost, sorry. We have been given it to be at 30 million. So we are going to less this. Let's check if there are additions. Were there plants that were purchased within that period? In question number 2, we have been told that plant X, which was sold and replaced on the same date with plant Z was acquired at 50 million. So in other words, plant X was sold in the year 2024. On the same year, a new plant, which is plant Z, was acquired And here now, we are not to determine any cost because we have clearly been told straightforward that it was acquired at 50 million. So in our additions, a new plant was plotted at 50 million. So we have that. So if you had 90 plus 50, that will be 140 minus 30. Here we are going to have 110. Now, let's continue. Then now we come to depreciations. Now, we need to note that in the depreciations, in the PPE, when we are preparing depreciations, I clearly say that depreciations can either be on a reducing balance or it can be at a straight line. At a straight line, if we were to be given at a straight line, then if our asset at cost is 80,000, then we do that. If it's at 90, we use the same rate to calculate our depreciation. But here the question is clearly telling us that depreciation are on a reducing balance. Depreciation number 3 states that depreciation is provided at the rate of 20% per annum on reducing balance. So the depreciation, we start from 2021. Now, from our question, now depreciation and okay, sorry, there's something that I have not mentioned. We are going to have depreciation at start. Then of course we will have the annual charges. Then we are going to have on disposal. And then we will have cumulative. And of course, we shall have our net book value. So we are going to have now note that on depreciation, at the start of the closing balance of the year becomes end depreciation at the start of it's calculated. Depreciation is calculated as at the balance of the previous year, which is the balance that is carried forward from the previous year. So the opening balance of the next financial year will be calculated on that depreciation. Like now, okay, what I mean here is that for us to calculate the accumulative depreciation, because you have been told that it's doing on a reducing balance, so at the start there was no depreciation. Why? Because in 2020 the assets were not in place. So the assets came in place in 2021 because most of these assets, we are being told they were purchased in 2021. And in our question, it starts that the purchasing is happening in 2021. So what that means here is that at the start, there was no depreciation that was brought forward. Then, what are the annual charges? In 2021, we have been told that the question clearly states that depreciation is provided at the rate of 20% per annum on reducing balance. So what that means is that the asset at cost of 2021 is 20%. So we are going to get 20% of the balance brought forward, or of the we can say the balance brought down, which is 80,000. So we are going to get the 20% of 80,000, which is going to be 16. If you calculate 20%, that will be 16,000, all that. So the annual charge, the 20% of depreciation for that period is 16,000. Depreciation on the disposal. Did we have any product that was disposed? If you look at disposals, they are not disposal. So it means that there were no depreciation for disposal. So cumulatively, that means that depreciation for 2021 was 16,000. I mean 16 million, because now it's in terms of thousands. So the balance carried down in 2021 becomes the balance brought forward in 2022 at start, so which is 16,000. Then we look the annual charge, the depreciation for the year 2022, and we have been told that depreciation is on a reducing balance. So what that means here is that the balance brought carried forward also for the asset at cost is 80,000. So what that means here is that for year 2022, the depreciation will be 80,000. It's in terms of millions, but now we are putting it in thousands for easier calculations, minus the depreciation for 2020, the balance or the depreciation for 2021 minus 16,000. If you calculate that, 80,000 minus 16,000, that is going to be 64,000. So the annual charge on depreciation for that year 2022 will be 20% of 64,000. So if you do 20% of 64,000, you will get 12,800. Sorry, 12,800. So 12,800 becomes the annual charge for that year. Then did we have any disposal for that year 2022? We did not have any disposal, so there's no disposal. So 16,000 plus the annual charge for that, cumulatively the depreciation for 2022 is 28,800. So this is the amount that we carry forward to the next year, which is 28,800. Then are there annual charges for, let's say the annual charges for 2023. Now in 2023, according to the question, we have been given the depreciation was that 6,700, the accumulated depreciation. You know, we are using the figures that we have been given here. So we can have our accumulated, we have been given to be that 6,700. But let's see, how do we come to this figure? Now, the annual charge for 2023 is in this manner. In 2023, remember, we have been given information that there were disposals that were done. Plant W was disposed in 2023, which was costing at 15 million. So what we need to take here in 2023 is for us is to take let me calculate, let me put in some more space, just a minute. Let's have 2023. Now in 2023 we have the balance that was brought forward to be 80,000. So we minus 28,800. That will be 50. Okay, this will be 51,200. Then if you try to look at the depreciation for that 51,200, that will be 20% times 51,200. That depreciation will be we are going to have 10 to 40. And then sorry, and then now this is the point. Remember, there's this information, the 15,000, which was on disposal. So what will happen? We will do for the one for the disposal, sorry, that is 20% times 15. Sorry. Yeah, right. Here, remember, we have reduced the depreciation. We have taken the balance that was brought forward minus the depreciation was brought forward. We got 51,200. We calculate the depreciation for that reducing balance. Remember, there was an additional, that was what I was looking for. There was an additional plant Y that was purchased in 2023. So the depreciation for plant Y, that will be 20% times 25. That will be 0.2 times 25,000. That will be 5,000. So if you had that 25, it comes to 15,240. So I want us, there's something that is here, but I want us to take this figure the way it is. So at this point, you have 15 to 40. Then now we have on disposal, the depreciation on disposal. How much? Sorry. What was our disposal cost? Our plant that was disposed was plant W. So, which was costing at 15 million. So on disposal, which was at 15 million, let's start that 15,000 to represent, because we are putting in the zeros. So we are going to do this accumulatively so that we get the depreciation from 2021 to 2022, then to 2023. So in 2021, there was a depreciation of 20% times that 15 million, which is in terms of thousands. So we are going to have that into 0.2 times 15. We will get 3,000. Then that is in 2021. So 2022, it's going to be 15,000 minus 3,000. So which is going to be 12,000. Then the depreciation for that is 20% times 20,000. Sorry, 12,000, which will be 0.2 times 12,000, which is going to be 2,400. I hope you are following. Then let me create some more space here. Then in 2023 now, we have the 12,000 minus 2,400, which is equals to 9,600. So 20% of 9,600 will be 1,920. So the depreciation for the disposal plant is going to be 3,000 plus 2,400 plus 1,920, which is going to be, that is 3,000 plus 2,400 plus 1,920. That is going to be 7,320. So for you to understand, we are doing the depreciation for the disposal. The plant that was disposed, plant W. So the depreciation, the cost, the cost of the plant was 15 million. So we are doing that accumulated because we have been told that it's on a reducing balance. So it means that we have to start the depreciation for 2021, find the reducing balance, come to 2022, all the way to 2023. So we have gotten our figure to be 7,320. So here on disposal, because it's a depreciation on disposal, what we are going to do, we are going to less it, because this plant was sold or was disposed. So we have 7,320 that we are going to dispose that. So if you calculate here, if you calculate 28,800 plus 15 to 40 will be 44,040 minus 7,320. You are going to get that 720. Now, according to the calculations, this is what it's supposed to be. But now, according to the question, we have been given the accumulated depreciation to be at 36,700. This is very much possible. It does happen. This is because of the different factors that must or which always play in the factor to have that difference. So we have a difference of 20 bob. So there are those factors that facilitates or that maybe differ, but in terms of our calculations, this is the right way to calculate. But now I will want us to use the figure that we have been given. So the figure that we have been given here is that 6,700, and for us we have found that 6,720. So just let's use the one that we have been given. But this happens because of different factors that might affect the cumulative depreciation amount. So here I will choose to go with the figure that we have been given. So if you have this figure, if you have that figure, that 6,700, let's 7320. Okay, sorry. For us, I want us to see if our annual charges are correct. Also, for us to have the figure that 6,700. With the on disposal, we have no problem with that. With the one that has been brought forward, we have no problem with that. So I want us to confirm with us, because now this has been affected because ours, our calculations are right, but I'm saying that because of the underlying factors, it can happen. So I want us to use the figure that we have been given in the question. So you will find that 28,800 minus 7,320 will be 21,480. Now let me have the year 21,480. So if you have that 6,700 minus 21,480, you're going to find 15,220. So that, you know, that figure of 20 which brought the problem, we will this calculation is correct, but now because of the question data that we have been given, I want us to go with the figure on the data. So we will change this to be 1520. So that our question is able, we are able to use the data that we have given. But I hope the calculation that we did at first, that is why I had to bring it first before changing into that, so that you see the calculations, the way they are moving from step to step. So we have that. So up to that point, then our carried forward depreciation at start to the year 2024 will be that 6,700. Then the annual charge for 2024, we are going to do it as the other one that we have done, because we have also we have information that we were given in 2024. The balance that was brought forward is 90,000. So we can less it from the depreciation brought forward, that is that 6,700. So we less that 6,700. So we'll get that to be 53,300. So if we get the cost of that from 2021, that will be 20% of 53,300. That will be 10,660. Let me just create some more space here. Okay. I hope we have not affected the next question. So we had that. So I said we get 20% of 53,300, which I got to be 10,660. Then we have so that is 53,300. Sorry, 300 minus 10,660. Which is equals to 42,640. Then 20% of 42,640, which is 8,528. Then we have 42,640 minus 8,528, which is 42,640 minus 8,528, which is that 4,120. So 20% of that 4,120, which is equals to just a minute. Just a point of confirmation here. From the additional information, we are being told that because according to our question, we are not given 2024. So in 2024, on that 1st December 2024, plant X, which was acquired on 1st January for 30 million was disposed at 21 million. So plant X, and we have been told that plant X, which was sold and replaced on the same date with plant Z, was acquired at 50 million in that year. So just like we have done from the previous, I think I was taking a longer route. Now, this is the thing. Because we have been given that the annual depreciation that we have carried forward here in that we have found in 2023, we have taken the balance that was carried forward to 2024, we less the depreciation amount at start. So we got the balance to be 90 minus 36. Then we calculate the depreciation for that amount. Then here we have a new purchased product. We have a new addition which was costing at 50 million, which was purchased in that year. So here we are going to get for the new addition, the depreciation for the addition, for the new addition we had is what the new addition was 50. This figure here, the new addition was 50. So that is the new addition, the depreciation for that will be 20% of 50. So which is 0.5 times 50. That will be 10,000. So the 10,000, if you had those depreciation, that will be 20,660. So in this part, our annual charge for this year will be 20,660. Then on disposal, there was a plant that was disposed. According to in that 2024, of course we have calculated, there's no need for me going up to the question. We calculated and what our disposal was 30 million. So depreciation for the disposal, we do the same way. On disposal, we will have, which is 30 million. Let's have in terms of thousands. In 2021, the disposal was 20% of 30 million. 0.2 times 30, that will be 6,000. Then you have 30 minus 30,000 minus 6,000, you will get 24,000. Then 20%, that is 2022 of 24,000. That will be 0.2 times 24,000, 4,800. Then 2023, we are going to have 24,000 minus 4,800. That is going to be 19,200. So we get 20% of 19,200. which is 3,840. 3,840 Then of course there's the one for 2024, which is 19,200 minus 3,840, which is 19,200 minus 3,840, which is 15,360. So 20% of 15,360 is equals to 372. So let me create some more space here. Anyway, let me just do it aside here. So we add here, we can add now our total depreciation for the disposal. We have that 6,000 plus 4,800 plus 3,840 plus 3,072. So here you can get this is 2, 7, 11, you carry 1, so that is 9. That will be 9, 17, carry 1. This will be 6, 10, 11, 14, 17. So we'll have we'll have 17, 7, 12. That is on disposal. So what that means here on disposal, we are going to have 17, 7, 12. So this one we are going to less, so that now if you have 36, 700 plus 2660 equals to 57, 360 minus 17, 712, that is going to give you 39, 648. So I think that is the figure that we have there. So then now we get our net book value differently. For 2021 it's going to be 80 minus 16,000, so we have 64 here. And then 2022 we have 80 minus 28,800, so we have 51,200. And 2023 we have 90 minus the 90 is there, minus that 36, 700, so we are going to have 53,300. And then 2024 we are going to have 110 minus 39,648, which will be 73,52. So basically this is our PPE. So you see the procedure that we have taken through, those are the procedures that facilitate and help us in coming up with the this PPE. So once you have prepared it like this, of course, I think I've shown you, just let me have it that way. Yeah, like that. So once you have it like this, of course, this is what is going to earn you the 8 marks. You can show the calculations that we have carried on as we have come along, and you find the goodness with financial accounting when you're doing the financial accounting question is that any step and you do it, sometimes you might not get the right answer, but out of 8 marks you might be worried you are getting, even if you got the wrong answer, you are getting 6 marks, because first you understand the format of a PPE, then you know the recordings, and then you know how which information to place there, and through the additional information how to calculate that. Then you have your PPE having been done that way, and then you're right to go. Then the last part in question 1 is that we have been asked, let me just remove this. We have been asked to prepare a disposal account for plant W and what you call this, for plant W and plant X. Prepare a disposal account for plant W and plant X. Why do we prepare a disposal account? Basically, the disposals are the assets that we have sold out. We prepare a disposal account so that we are able to determine whether we dispose the asset on a profit or on a loss. That is the main objective for preparing the disposal account. And you only prepare disposal account for only the assets which have been disposed. And for this matter, the question is clearly asking disposal accounts for plant W and plant X. So we know very well that from the additional information, these are the only plants that were disposed. And and also you need to know, there's some information that I've prepared which you need to know is that when you are preparing a disposal account, first you need to ensure that cost, you have cost of the plant. We said cost at the purchasing cost, which is debited, and then the accumulated depreciation, which is also the accumulated depreciation is credited, and the sales proceeds are also credited. Then the balancing figure, which can be either on the sides, if it's on the debit side, it becomes a gain from the disposal. If it's on the credit side, it is a loss on the disposal. So our disposal plant for plant, our disposal account for plant W is here. So you see, we have debited the cost. Plant W, which was disposed in 2023, was costing the cost at purchase was 15 million. So we debit the cost. Then at the same time, we credit the sales proceeds. We sold, this plant was sold at 8 million. Then the accumulated depreciation was 7, because we have calculated all those, the accumulated depreciation. We got that, remember, from our PPE. So from our PPE, you see we have calculated here the annual, the annual disposal, the depreciation on disposal was 73.20 million, which is in terms of thousands. So here, in our accumulated depreciation was 7,320,000. So, and then the cost here. Now we have the balance, the total amount is 15,320,000, which is also on the other side. So the balancing figure comes on the debit side, which is 320. So it becomes, we refer it as a gain on disposal. Equally on X, disposal of plant X, the cost of plant X was 30 million, which was disposed. The sales proceed we credit them, which is 21,000. So the accumulated depreciation also for plant X, we found them from our calculations. We have the depreciation for disposed item was 17,712. So we credit the accumulated depreciation at 17,712. So the total figure comes to 38,712,000, and also on the other side 38,712,000. So the balancing figure, which is 8,712,000, becomes a gain on disposal. So that is it for our question 1, and I hope it's clear and you enjoyed our class. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions, and also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.